A very good afternoon to everybody. It's a very difficult topic to catch attention when it's lunchtime and it's all equity oriented. So maybe I'll start by honestly confessing something. Uh, my personally, like people invest as an analyst or a fund manager, we do lot of analysis, paralysis, Excel sheets, IRRs, market analysis, call, attending calls. Ultimately, when we go to the investors, investor simple बोलता है कि पैसा डबल कब होगा. So ये analysis paralysis तो हो गया. And that's what, if you see the previous panel, like all the analysis has been going on, but unfortunately the investors focus in how the money will get better and he will increase his return. It's like a simple philosophy. If you look at it, I meet so many investors, सबको चाहिए equity के समान return चाहिए, FD का safety चाहिए, real estate का pride चाहिए, mutual fund का liquidity भी चाहिए और crypto का excitement भी चाहिए. तो आपको life में ऐसा सब mix नहीं मिल सकता है. And from that perspective, if you look at it, I think you need to pick your spot, what is suitable for you actually. And in your risk reward, how you think, what is better for you in terms of your portfolio allocation, portfolio diversification. So beyond equity, if you have to look at other asset classes, how do you think of what should you be investing or not? Now, private capital per se is a very, very large landscape. I don't think so I would be able to do a justice in 20 minutes. So what I have done is that we are capturing two broad aspects of private credit. One is private credit and on real estate. So which comprise of the larger chunks of the market in terms of the investments. Just taking a step back, what is happening globally, and when you speak to your clients or as an individual investors, how you are looking at your portfolio allocation. Globally, the equation of 60-40 has tilted, and it has happened over the last 10 years, where effectively alternates has become a large part of allocation within the family offices, institutions in the global markets. Today, if you are not in alternates, I think at some point of time, you may have to go back and retrospect, like why have you not invested in alternates as an asset class? It is not necessary credit or real estate, but whether it's a venture capital, venture debt, or any other strategy or special situation fund. So this is a trend where we believe beyond equity PMS, the other parts of the private investments are going to get much bigger in India. What we started in India about 5-7 years back is already going bigger and bigger. Basically, we have seen very large increase in Cat 2 investment commitments from various investors. The number of family offices and HNI, thanks to the capital markets, have increased dramatically. And people are allocating stocks. Basically, promoters are now selling their 70p stocks and investing in lower p stocks or other asset classes to diversify their portfolio. And what we are seeing now, larger family offices and individuals are allocating between 10 to 15% of their overall portfolio into alternates. I will just delve upon the two pieces of product which we are going to discuss. And I know it's slightly very different from equity, though Nifty over 25 years would have given only 13-14%. So it's not that Nifty has given like 50% return. Unfortunately, we believe like equity can always give a 2-bagger, 3-bagger return, but on a weighted average portfolio, if you all go and introspect, I don't think so it give that kind of return. So if you look at the various parts of the thing, like these are the traditional pools of capital where people who have been investing in fixed deposits and credit risk funds. And subsequently, what the two pieces which we are going to discuss is on performing credit and office yield. And with a kind of a limited downside and a low volatility, you may expect a good return in terms of risk reward. It is far superior as compared to any other asset class. Quickly about ICICI Prudential, like we manage about nearly $110 billion. As alternates, we are one of the largest AUMs in the industry, managing nearly 45,000 crores across public equities, private credit and real estate. And we would be the first movers in the business when we started this business about 6 years back. One of the key dominant factor when you look at private capital, like it is the institutional advantage, which is in a big thing, whether your relationships across corporates, the governance framework, the kind of a network among the various set of people you are doing the business, and more importantly, like how the entire process of approvals and underwriting works, which I believe is very, very integral part, whether do you equity or debt. So the two parts which we are going to discuss, Private credit. Quickly getting to private credit, very much is noise. If you see lot of news flows coming in private credit, India is in very, very nascent stage as compared to global market, which is $3 trillion. We are just about $25 billion. So there is a long runway to growth. And this is what the banks and funds will go together. So we are kind of complementing to banks. It's not that we are taking banks' market share. We are add-on providing capital to the sponsors and the promoters beyond what banks can provide them. What is most important and which is one of the reasons the equity markets have done well, Indian corporates, as we've seen last 20-25 years, has been the most healthiest as we speak right now. The ratings have been doing much better. Operating cash flows across the companies is doing very good. If you look at the debt equity ratios, this is doing well. Though it helps in the equity as well, but at the same point of time, when you look at credit, it is very important that you are able to select right kind of sponsors and promoters to give money. One of the key game changer which has happened, which has helped the banking side, is the IBC reform, the bankruptcy code. And just I want to spend 30 seconds on this. Perception is it is a very bad law. It takes a lot of time for recovery of money. But my request is just focus on this number. Today, till date, about 40,000 companies have been referred to IBC, of which 30,000 cases have been resolved before admission. Because it's a two-step process. You first refer and the judge decide whether to admit or not. I think the fear of the promoters, whether he will lose his company, is far high right now. And that's the reason the borrower discipline in India has improved dramatically over last 10 years. And that's one of the reasons we see the corporate India is so healthy as it is right now. Private credit as a market is going better and better. What we did last full year, we have already invested as an industry $9 billion in first 6 months. All the marquee names, most of them are part of the listed families and groups where we have provided the capital across industry. Shapurji Palanji would be one of the largest deal in the Asia Pacific of this size of private credit deal which has happened. So investor interest in India across private credit is very, very large, whether it's global investor or domestic insurance or banks or family offices. I think this is a kind of a landscape of the credit which we believe people should know. I think जितना ज़्यादा रिटर्न चाहिए उतना आपको रिस्क ज़्यादा लेना पड़ेगा. तो अगर आपको स्मॉल कैप टाइप क्रेडिट करना है तो this is the part. It doesn't mean that is bad, but the risk is far higher to get that kind of return. And if you want to play kind of a safer and a moderate piece, so this is the side of the part of the chart you should look at it, because each of the thing comes with their own nuisances. Like if you are deal with defaulted companies or promoters who have leverage, or you have to underwrite a turnaround, then you have to take that risk, but you will be compensated for those by the returns as well. If you want to take like more banking kind of a credit exposure, performing credit would be one of the baskets which would be of interest to the investors. I think this is a simple checklist. Everybody will have their own checklist. This is like the checklist we use, and I think it works perfectly whether you do debt or equity. I think if you implement this as an equity and debt, I think it will work beautifully. I think there are certain very basic rules which we follow, like we don't do distress, we don't do greenfield projects, we avoid asset light and working capital intensive businesses. There are certain sectors, like in the previous comment, Vikas mentioned, like he doesn't invest in certain sectors. We have also simple rules like where we don't invest our credit, like trading, EPC, jewelry, media, microfinance, or a new age company. And any business group which has a history of default, again, we don't invest in those companies. I think the most important parameter in India, if you do debt or equity, is the promoter. I think who is the counterparty is the most important thing in India. And I think if you get this wrong, you will lose all your capital, whether you do debt or equity. I think the next important thing is vintage. We believe over a cycle, you will get to know about a company or a promoter, how has he dealt in a bad time, because in history we have been seeing like every company or an individual goes through patches in life of ups and downs. And the most important test of an individual or a company is how is he behaving and dealing with his stakeholders in a bad time. And I think that is very important, and for which you need to have a 10-15 years cycle at least. And that's one of the reasons. And also from a financial perspective, at least you can see 10 years balance sheet. Maybe many of us don't read balance sheets, but it is very critical, like what has he done in balance sheet over last 10 years? How many mergers, demergers he have done? Have we understood that or not? And that's one of the reasons the vintage of operations really helps us. And the other things on credit, if you look at, is our cash flows and collateral, very important, like how you recover your money back. I think the risk out here is, what is the credit risk? The money can go bad because the borrower may not pay you back. The portfolios are generally diversified. This is a Cat 2 fund, so these are generally illiquid products. So basically you can't have money coming at your demand. The fund manager or asset management team will give you the money when the underlying portfolio is matured. So this is part on the credit side. I will quickly jump onto real estate, and this is an asset class. Either people love it or people hate it. I don't think so. In a personal experience, most of the people, if you speak, generally people have a tendency that real estate mein paisa nahi banta hai, and which may be fair because unfortunately most of the money is made by the people who are getting into the land stage or a development stage. Again, if you look at it, real estate, one of the key things, India is becoming an office to the world because we have the best manpower and we have the cheapest rentals. And that's one of the reasons every day in the news you will see like the number of GCCs or the global companies which are relocating their offices. And it is not only tech services. So the misunderstanding all we have is only technology outsourcing ho raha hai. Aisa nahi ho raha hai. If you go to Bangalore or few other parts, you will see a lot of PhDs being hired by the pharma companies to do their research in India, and which is going to be an add-on thing beyond what we have seen in last few years in terms of tech-only revolution. We are seeing much more companies like engineering, automobiles, and pharma companies globally are setting up offices in India for the entire research and development work. The market opportunity is very large. It's nearly $1 trillion opportunity, so you can't miss this. And one of the key things, the hypothesis I have, if real estate is not doing well, none of your markets will do well because everything, whether you make steel, whether you make cement, whether you make consumer durables, everything will go in real estate. If real estate is not selling, the entire market at some point of time, maybe with lag effect, will go down. I think again, real estate, two big changes. I think RERA, I think it has changed the dimensions. Again, people may say it's misuse, but if you see the better side of it, I think the discipline and the consolidation in industry has really helped in the real estate sector to make it a much better industry to deal with actually as compared to what it was in past. Quickly in real estate, what are the products? People look at it. I think the simple thing is to invest in REIT, which are listed. You get an rental yield, cash flows. Then there is a pre-list, which is a product called yield products in Cat 2 funds. And you can also take higher risk in form of a development fund or a credit fund giving money to real estate. So different parts, different return, different risk you need to think of yourself. Office we discuss is very large. I think the $1 to $2 rental in India is the big game changer. As long as the rents are in that zip code less than 200 rupees per square feet, it will make a lot more sense for people to move to India along with the talent which is far cheaper than their home countries. Rentals have gone up, vacancies are nearly all-time low. I think this is, we are talking about tier 1 offices, we are not talking about retail shops or startup buildings. These are very large tier 1 offices, what like a Embassy will own or what a Brookfield will own or what a Blackstone will own. And again, this is a big driver of demand which is capturing in India actually. Simple math in like a office fund or REIT would be, you get a 7 to 8% rental yield, you get an appreciation because of rent escalation, and you also lever it up actually to some extent. So basically, this is the financial engineering part in any office fund or a yield fund which you will do, which will give you a 15-16% return. It slightly looks very simple in terms of the numbers, but actually, if you look at it, this product actually can deliver 15-16% with an asset which is owned by yourself actually. So think of an asset which you own it, you have a constant cash flow of 7 to 8%. You have given it to a tier 1 counterparty. So this product, and the other beauty is the taxation on this product is substantially in form of capital gain. So this product is something which can give you 11 to 12% in a base case, assuming the underwriting goes right, on a post-tax basis, and in an upside case, the returns can be far higher. I think the key risk out here is vacancy. The biggest risk, today you have leased a property to say TCS and TCS may vacate it. That's the thing where the micro market research is very important. What kind of research and underwriting you do out there is very critical. What kind of infrastructure is coming in, what kind of new office blocks are coming in that part of the city. I think that is something you need to do more deep dive before getting into any property. The portfolio and generally in these funds are well diversified between 7 to 8 properties. So as an individual, you may look to buy a 25 crore property, but that would be single asset, single tenant and single city. If you invest through a fund structure in that, you may have like 5 cities, 5 properties, 5 different tenants. So kind of a diversified portfolio. Again, these products are illiquid, like in real estate, you don't get a liquidity very easily. So it is a 5 to 6 year horizon investment horizon product out there. And the exit is a risk. If the micro market and economic scenario goes down, yes, exit at that point can be a big challenge out there. From an investor perspective, how do you think of investing in this fund? If you think of like that, I think most important thing, again, the way we look at it, who is the promoter? I think as an investor, people look at it, who is the sponsor? How much money has the sponsor invested in the fund? What is his skin in the game? What is the underwriting thesis in private side of the businesses? It is exactly similar the way you think through a PMS or a AIF manager. Nothing more different. You look at the team experience, you look at the past track record, how diversified is the portfolio, what is the cost structure of the fund. Effectively, don't get guided by what is the gross return, always guided by that what is the net of expenses coming to you. I think most of the thing which I have seen investors meeting it, people say कि कितना देते हो, and वो भी उनको absolute देखना है कि 20% दे रहे हैं, 18 दे रहे हैं. Eventually, you should see what is the net of expenses to you and what is the tax treatment in that product and what is net of tax return to you. So if you look at it like from your perspective, you should think these asset classes at a kind of a diversification within your broader portfolio, which will give you much less volatility, more regular income, and definitely it will not beat equity. But one thing I think is a quote which I want to end with. Generally, it is very easy to be smart for 1 year. It is very important and very lucky to be smarter for a 20-year period. I think we have seen a 5-year period where everybody has been lucky. If you just go back 20, 30 years Nifty record, you have made 14%. Yes, people may say I have made so much return, but I think a consistent long-term return product, I think that is we believe as a private capital investments can give you. It may not give you 20%, but maybe a 10, 15% return is something, depending on the asset class, they will look at it. Thank you very much.